So you want to learn about the PDE ratio? Well, I want to learn about magical financial ratios too. Great. Okay, let's do this. So what is the PDE ratio? It is the price per share of a company divided by its earnings per share. Typically, you'll see an acronym TTM next to PDE ratio. That is the trailing 12-month period. And what it does is taking the earnings from the last 12 months to give you the earnings part of the price to earnings ratio. Why that's important is because if it's in the middle of the summer, you don't want all the earnings data from the previous year. You really just want the last 4 months. You'll also get forward price to earnings ratio. That's where experts will guesstimate what the earnings will be for the next 4 quarters based on what the company is projecting and what the analysts actually believe the company will really do. So great. What does price to earnings ratio really mean? So what it really is how many years it will take from this moment in time for that company to make back the money that it's currently worth. So for example, if a company is worth $1 billion and it's making $100 million a year, well, at that pace of $100 million, it's going to take them 10 years to make back the current price of the stock, a PDE ratio of 10. So in essence, in essence, a investor looks for a price to earnings ratio of 8 to 10. But that's not really a good standard for all stocks. That the 8 to 10 year range comes probably from historical precedent. If you think about it, the risk-free rate, which is bonds and anything riskless, getting bonds from the government, those generally had a 5% return, give or take. If you think about 5%, what that means is if you get 5% every year and you ignore compound interest, because we're not doing advanced math here, it would take about 20 years to make back your investment on a risk-free investment. 5 times 20 is 100. So the stock market has a little bit more risk, so you would expect a better return. So if you were taking up more risk and buying a stock instead of a risk-free bond, then you would expect a better time frame, right? Like a 8 to 10 year range, give or take. The problem is that right now in 2020s, the current meta doesn't really allow you to make these assumptions anymore. Interest rates are ridiculously low. You're lucky if you get a 1% interest rate on a risk-free investment. If you think about a 1% interest rate and you ignore compound interest because we're not doing advanced math right now, please stop talking about it in the comment section. A 1% return means it will take 100 years to make back your investment in earnings on that investment. The other problem of why the PDE ratio is a little antiquated at this point is companies like Amazon. Amazon's PDE ratio is typically from 60 to 90. What that means is if they don't earn any more, if they don't increase their earnings every quarter, then there's going to take 60 to 90 years to make back the return on the price that you bought it at. Yet people buy Amazon stock all the time. It's one of the largest companies in the world by market cap. Why is this happening? What's going on? Don't people realize PE ratio is telling them no? Well, what's happening with Amazon and other tech companies is whenever they make money and earnings, they're pretty much reinvesting all of that. So what would have been a higher earnings now changes into a lot of costs because they're reinvesting it to make more revenue the next quarter. So their earnings will go up over time, and hence they're not going to have the same earnings every quarter. Every quarter they increase because they've reinvested all of it. So between a very low earnings because they have such high costs because they're reinvesting all the time, and the fact that the earnings and revenue are increasing very, very fast, uh, people really can't use the PDE ratio for Amazon because it doesn't represent historically what would be a good ratio for it. Now, I ragged on PDE ratio for, I don't know, 4 or 5 minutes now, but PDE ratio does have its use still. Broadly in the market, if you see PDE ratios getting pretty high up there, might mean that there's a problem with the market. There's a little bit of a saturation of money. And the moment that money starts going away, things might resort back to historically normal PDE ratios. So do your research, understand the PDE ratio, and figure out when it's the right time to use it. My name is Chester Johnson. I'm the co-founder of StockTeamup.com. This is Finlit. We do financial literacy every week. Thank you.